Professional traders know something beginners don't. Price doesn't bounce randomly, it bounces at specific levels. These levels are called support and resistance. And here's the key. These levels are where professionals enter and exit trades. They're not guessing, they're not hoping. They know exactly where to buy and where to sell because they know where the levels are. Most beginners ignore these levels. They trade without a plan, price hits a level, bounces, and they miss the move. Or price hits a level, breaks through, and they get stopped out. This video shows you exactly what support and resistance are, why they form, and most importantly, how to identify them. By the end, you'll see these levels on every chart. Let's start with support. Support is a price level where the price stops falling. It's a floor. Price comes down, hits support, and bounces back up. Why does this happen? Because at that level, there are buyers. Buyers who remember the price was there before. Buyers who think it's a good deal. Buyers who missed the previous move and want to buy the dip. So when price falls back to that level, these buyers show up. They buy, price bounces. This creates a pattern. Every time price falls to that level, it bounces. This level now has a reputation. Price respects it. Professionals see this level and think, where can I buy the bounce? They set their entry right there. Now resistance. Resistance is the opposite. It's a price level where price stops rising. It's a ceiling. Price comes up, hits resistance, and falls back down. Why? Because at that level, there are sellers. Sellers who remember the price was there before. Sellers who made profit there. Sellers who think it's time to lock in gains. So when price rises back to that level, these sellers show up. They sell. Price falls. This creates a pattern. Every time price rises to that level, it falls back down. This level also has a reputation. Price respects it. Here's the key insight. Support and resistance flip roles. A resistance level that price breaks through becomes the new support. A support level that price breaks through becomes the new resistance. This is role reversal. It's how levels evolve. Now the practical part, how to trade these levels. In an uptrend, price makes higher highs and higher lows. Support is the higher lows. Resistance is the higher highs. Professional traders see an uptrend and think, where's the support? They buy at support, targeting the resistance. Price bounces from support to resistance, they profit. It's a repeating pattern. In a downtrend, price makes lower highs and lower lows. Resistance is the lower highs. Support is the lower lows. Professionals think, where's the resistance? They short at resistance, targeting the support. Price falls from resistance to support, they profit. Let me show you a real example. Price is in an uptrend. It rises to resistance at $4,500. It sells off back to support at $4,480. A professional trader buys at $4,480, sells at $4,495. Profit $15 per contract times 10 trades, $150. That's how they make money. They trade the levels. Here's why this matters. When you trade these levels, you remove guessing. You know where to enter at support or resistance. You know where to exit at the opposite level. Your plan is predetermined. Price either respects the level and you profit, or it breaks through and you exit with a small loss. No emotion, no hope, just levels. This is how professionals stay profitable. They don't have better instincts, they trade levels. Video 5 shows you exactly how to enter trades at these levels with precision.